Good morning. My name is Jim Barrett. I'm in charge of institutional sales here at Barron Capital. This morning, we're going to have a discussion of the Barron Partners Fund, along with the Focused Growth Fund and the Focused Growth Strategy. With me today is Michael Barron and David Barron, both co-portfolio managers. Michael for the Barron Partners Fund and Strategy, and David for Focused Growth and the Focused Growth Strategy. What we'd like to talk about today is performance in the first quarter, especially as it relates to the difficulties that growth equities had in the fourth quarter of last year. I think a basic theme is really the bounce back that we had in growth equities. And at this point, let me just turn it over to Michael, who's going to talk specifically about performance in the market, performance of our fund, what was driving it, and also some detractors. So at this, let me turn it over to Michael Barron.
Sure. Thanks, Jim. I think you're exactly right. You can't, I don't think anyone was really anticipating the quarter that we had both in the markets and for this fund. As we exited 2022 last year, investor sentiment was extraordinarily low. People were concerned about a host of factors. Ukraine war obviously is ongoing, but some more specific things in terms of higher interest rates or rates continuing to increase. Inflation being stubbornly high, some announcements of job losses and cutbacks in corporate spending. So everyone's really anticipating the worst. And what we found is when you're investing in high quality growth businesses, they're able to weather these kind of storms. They took oftentimes the appropriate steps to manage this uncertain environment. So like I said, the market did well. Look at numbers here. So for the Russell Mid Cap Growth Index, which is our closest benchmark, it's a 9.14% return over the 3 months, but we did considerably better. The Barron Partners Fund institutional shares rose 23.4%. And it's not just a once in a blue moon scenario. Obviously, it was a very good quarter, but from a multiple year standpoint, this fund has done extraordinarily well. From a 3-year, 5-year, 10-year, we substantially outperformed our benchmark. For 3 years, it's a 43.3% annualized return. It's important to remember annualized, 43% annualized return for 3 years, 26.4 for the 5 years, and around 20% for the 10 years, all substantially above its index. And this is now the #1 fund across many of those periods, but especially since its inception as a mutual fund. So happy to get into any of the drivers that you want to take the conversation, Jim, but that's the overall recap on the market and the fund's performance.
Perhaps you could talk a little bit about Tesla. I mean, that's been a driver in the fund and the strategy for a while. What I thought was interesting was kind of a switch from the fourth quarter, where it was a detractor, to how it did in the first quarter, where it was an important contributor performance, and how that kind of fits into our view on the long-term performance that you expect from Tesla.
Sure. You're right. It was a big reversal from the end of in Q4 of 22 into the first quarter of 21. It wasn't the only company that did well. Actually, most of our companies did very well. I talked about this in our quarterly report if you wanted to reference that for more detail. We have companies like MSCI did well, Hyatt Hotels, IDEX Labs, and kind of the commonality between all these companies is they have pricing power. So these are companies that are heavily ingrained with their clients. And when you get these kind of environments, they're able to take price despite some of those macro concerns. But it does, it is important to focus on what's going on in Tesla. It is a major position at this fund. It wasn't purchased as a major position. It was purchased as a substantial position, but as a result of being correct in our analysis and appreciation, it's risen substantially. It was around a 37% average weight over the course of the quarter, and the stock gained 68%. It's helpful to rewind a little bit, understand really what drove the stock price to fall rapidly at the end of last year, and many of those factors have reversed. There was a lot of exogenous factors that caused the decline at the end of Q4, and people are realizing that it was exogenous and they're not going to continue. Those being basically the acquisition of Twitter by Elon Musk. I view a little bit of it as a financial burden and a distraction. What's going on over in China with the zero COVID policy and how that's going to impact demand and production. And then just general fears about a recession and some of the government policies to lessen the impact of such, basically causing a delay in purchases as some of the Inflation Reduction Act policies, come to fruition. And like I said, Q1 was the reversal. So Twitter is doing better. It's reported that it's kind of trending towards break even. So less of a distraction, less of a financial burden for Elon. China, things are going well there. It was a tough period, but now they're back to, I guess, approaching record levels of both production and deliveries in that region. And then domestically, we're kind of seeing, or in the more developed markets, we're seeing that demand is basically 2x, twice as big as our current capacity. So this is not a demand issue for their product. It is highly sought after. And like I said, the stock rebounded accordingly. It's a lot of these factors are kind of put behind people. We didn't sell during this kind of volatility. We didn't sell on the way down in Q4, and we didn't sell as the stock rebounded. We had sold in 2020 and 2021 around a quarter of our shares, I think maybe a little bit more, 27% of our shares at an average price in the low 200s. But the reason we didn't sell now is we're further along in the growth trajectory of this company, and we have further confidence that they're actually going to achieve their long-term goals. And that is getting people onto renewable energy and be extraordinarily profitable in the process. And the only way to do that is not to focus on these high-end vehicles that we historically have done, whether it be the Model S and Model X and even the Model 3 and the Model Y. That's only a subsect of the market for vehicles. We've spent a lot of time with this company over the years and gained greater confidence that they can take substantial costs out of the vehicle to the tune, right now our estimates are around $15,000 of cost and going after a much broader market. We see this, if you can get $15,000 out of the vehicle and still make a very healthy profit on those cars, we think this is a 40 million vehicle market, and we can take a substantial share of that. You gotta remember, we're only doing 2 million vehicles or so currently. So going after this 40 million market is substantial. And through conversations with them, through their analyst day, where we feel the confidence is what they can do on the battery. How do you get costs out of the battery? How do you, what's in the car that doesn't need to be in the car? Taking more content out of the vehicle. How do you improve manufacturing and assembly? How do you do it with more robotics, with less people? How do you get production up in these various facilities? They're underutilized. So that'll improve the margins and the costs associated with each vehicle. So there's a host of factors here that we feel that will drive the cost down to manufacture by around $15,000. It's going to be volatile. It's remained volatile. It's remained volatile into Q2. There wasn't an immediate launch of a new product that caused some hesitation with some short-term traders. But we have remained confident. We speak to the company consistently and believe they are, driving on to their long-term goals. And right now, it's going to be all about volume. So getting costs, lowering the ASP, the selling price to improve the volumes in the short term, but eventually increase the market share by launching this lower end vehicle, or more affordable vehicle, I should say.
Thank you for that explanation around Tesla. What I also thought was interesting about this quarter, and I think it ties into what happened in regards to, I don't know if we call it a full-blown banking crisis or a mini banking crisis or a regional banking crisis, but Schwab, which was one of our best performers in the fourth quarter of last year, we specifically talked about it in our quarterly letter. Again, like Tesla, they kind of flipped in the first quarter, and I know it was related to the financial market or the issues around regional banks. But I'm curious your views on that, and then what our longer term perspective is on Schwab, given that this has been a very good stock for us for many, many years.
Sure. I think there's a commonality across a lot of our businesses that we're investing in. It's optionality. It's having businesses that do many different things. To go back to Tesla just for a quick sec, because it made me think of it with that question, they can be much more than just a vehicle company. What can they do in terms of batteries and energy? What can they do in terms of software and autonomous? What can they do with insurance and robotics? There's a lot more optionality in that business than just purely selling vehicles. And Schwab's the same thing. So people focus on one aspect of these businesses. So in Tesla, like we said, we focus on how many vehicles they might produce in any one given quarter, or what the price of that vehicle might be. And in Schwab, when there's negative headlines, they're focused on this bank that's inside of the Schwab Corporation. You have to rewind a little bit in terms of what Schwab is and why there's a bank there. Schwab started as a discount brokerage business. It remains a discount brokerage business. It started its bank around 20 years ago to provide a better service to clients, a more holistic approach for clients, creating a stickier client base, allowing them to lower cost to service clients. Competitors didn't do this. Having a bank is, I wouldn't say risky, I would say much more costly. High regulatory costs and oversight costs, and something that other competitors didn't want to do. Schwab went into it because they saw there's a benefit to the end client. However, you entered a period like we saw at the end, or I guess it was the beginning of March, end of the quarter, where regional banks had a lot of concern, actually, to put it lightly. A little chuckle at it, that you put it out, Jim. We'll call it concern. There was flight. Interest rates were rising. There was a mismatch in duration. There could be a hit in some of these earnings. And there was flight in these assets. Clients were getting scared and pulling them and going into other banks. We don't invest in traditional banks, or very rarely have we invested in traditional banks. There's no traditional banks currently owned in Barron Partners Fund. However, there is this bank that sits within Charles Schwab. We think Charles Schwab is very different than these regional banks. The regional banks, like I said, is one kind of business. We are truly a discount brokerage firm. There will be a short-term hiccup to earnings, a shortfall in earnings, as some liabilities are, I should say, some assets are marked to market, which will cause a shortfall in some earnings. But we don't see this being a systemic risk to Schwab. There's no flight to other businesses. People need to hold money at Schwab in their bank in order to facilitate their investing activity. Additionally, most of the assets, around over 80% of the assets, are below the $250,000 fully insured limit. And actually, in the long term, these higher rates and cash are going to be a benefit to this company. So short-term hiccup, but that's how we're going to make a very substantial margin in the future. And as we said earlier, there's not a flight going to other asset or to other competitors. There's actually flight in to Schwab. March, when this was all announced, was, I think, near, I can't say exactly a record, but near a record month for Schwab. If something over $50 billion came onto their platform. Exactly. In terms of their inflows, and a portion of which will be in cash. So we remain very positive on the long-term prospects of that company. We think the higher rates are actually going to be a good thing in the long term for Schwab. We think their bank is a competitive advantage. We want them to keep the bank, and we actually bought a little bit during this dislocation. As the stock came in, we were able to buy a little bit more of that stock. So,
thank you very much, Michael. Is there anything else that you would want to highlight in regards to the Partners Fund for either existing clients or potential clients, or should we turn it over to David at this point?
Nothing really comes to mind. We do write a quarterly letter that we spend a good amount of time on, so I encourage people to read that and digest it, and come back to us and our sales reps and anyone on Jim's team with questions and follow-up. Happy to answer it. But we're very happy with the structure of this fund, of its long-term performance, and we're very optimistic about it going forward.
Yeah, I would recommend our clients and potential clients to read and study our quarterly letters, because there's great information there on how we manage and how the specific funds are managed. At this point, let me turn it over to David Barron, who is the co-portfolio manager for another one of our very successful products, the Focused Growth Fund and the Focused Growth Strategy. So David, maybe a few comments on what you're seeing, and then also how it relates to your specific portfolio.
Sure. Thanks, Jim. Yeah, I'll talk a little bit about performance. I'll talk a little bit how we're managing the portfolio through these very volatile times. A little of what we're hearing from our companies, and I'll give you a quick take on what we're hearing, what we're seeing in the markets, and why we think now is an attractive time to be investing in the fund. So for the first quarter, the fund was up 14.5%, and that beat the benchmark by about 800 basis points. And while it was a little volatile, I mean, fourth quarter was tough, and it was a quick rebound in the first quarter, given the constant battle between a still strong consumer and high interest rates and inflation may cause a recession. So far, how I imagine the fund, it really hasn't changed. We're still, except the fact that we're still better able to buy these stocks at what we view as very attractive prices and significant discounts to what we believe these companies are worth. We continue to look for companies with significant pricing power due to some kind of competitive advantage that are constantly raising prices and are still able to retain their customers on a yearly basis, like CoStar, MSCI, FactSet. Or we're looking for companies that have cost advantages and are able to provide services and products at the lowest possible cost, and charge the lowest prices while taking market share, like Tesla, FIGs, or our newest investment, like Interactive Brokers. So what are we hearing from our companies during these volatile times? Thus far, our companies are not seeing a slowdown in demand for their services and products. They're still seeing strength in their businesses with significant pricing power, and have still been able to raise price while maintaining strong retention rates of their customers. Recent examples like CoStar, MSCI, FactSet, Vail, they're all seeing steady growth in their businesses despite price increases. They all have great balance sheets with minimal refi risk and interest rate risk, and they continue to use the cash flow to reinvest in the businesses and use excess cash to return to shareholders through buybacks and dividends. And we believe many of these stocks, while they are being priced in significant recession scenarios, and some are pricing in pretty significant declines in earnings this year and next year. And we think that if we don't enter a slowdown, or it's much less than people expect, our investment should have significant upside. We think many of our stocks continue to be cyclically depressed, not secularly challenged, and these stocks are being overly punished. The consumer still has $1 trillion of savings built up over the past 3 years, and there's still over $2 trillion of private equity capital on the sidelines waiting to be deployed. And when you talk to PE firms and private equity firms, they still say that they see the most value in the public markets. So we think that capital should be deployed over the coming years and help significantly support our investments and stock prices. As a result of all this, we have fully invested our cash balances, where the fund had almost 8% cash at the end of 22. We had just 1% cash at the end of March, as we saw many attractive opportunities to buy stocks at what we saw were unusually attractive prices. As I said before, we added new positions in Interactive Brokers, a leading securities brokerage company that provides services to retail and professional investors. And their advantage is they're a low cost provider. They provide the lowest prices and serve a vast array of markets outside the U.S., whereas other companies just don't have the manpower to do it. They serve just 50 billion of retail assets out of 25 trillion, and they continue to grow clients at a rate of 20% a year. So there's still significant growth opportunity. And they do very little marketing and rely heavily on word of mouth, which enables them to generate really high margins while still investing in new products and services for their clients. They focus on automation and should enable it to continue to be a low price provider while earning best-in-class margins. We think this should lead to double-digit revenue and earnings growth over the coming years. I think the stock is very attractively valued. In the quarter, we also increased our position in MGM Resorts, as that company continues to see strong growth in Vegas, as well as sequential improvements in Macau as China reopened following the pandemic. We think at current levels, you're getting MGM's 3 growth projects for free at current levels, including new game licenses in New York and Japan, and its 50% interest in BetMGM, its online digital gaming business, which could result in as much as a 50% improvement in cash flow from current levels. And all the while, MGM continues to use its excess cash to repurchase stock, which we think is a sign of continues to see value in it. And it still has a really strong balance sheet in a net cash position. And the stock was down 25% last year. And we believe its valuation and growth prospects remain attractive at current levels. And lastly, while I know many people are still concerned about rising rates and the underperformance of the fund, the focus portfolio has actually done quite well during periods of rates are increasing. And this is because we invest in faster growing companies that constantly invest in themselves to continue to grow through any type of market. And we continue to believe that earnings growth should continue to drive the stocks from here, as most are already pricing in pretty recessionary scenarios this year and next. And as I said before, we believe the stocks are cyclically depressed, not secularly challenged, and should recover over the next 1 to 2 years. And finally, it should be noted that the fund has outperformed by 550 basis points over the past since inception. So we're proud of that, and we still see upside in the fund over the coming years. So I'll turn it back to Jim for
Thank you very much, David. I especially appreciate that comment about some near-term cyclical issues, but certainly not secular challenges in regards to either of our portfolios, which, as we mentioned, are among not only the best performers at Baron Capital, but a couple of the best performing products in the industry. Thanks, Michael. Thanks, David. Any questions that you may have on these products or any of the Baron products, feel free to contact your sales representative. Also, love to direct you to the quarterly letters. As I mentioned earlier, that's a great source of information on what we do. I'd like to thank you for your time today, and especially thank you for your confidence in Baron Capital. Thanks again, and have a great day.